A little over a day ago, this guy by the name of Meet Kevin came out and made a video titled Why I Sold a Stock I Like. Well, it just so happens that the stock and company he's talking about is the Tattooed Chef, ticker symbol TTCF. Now, if you're new to the channel, this is a company that I've been talking about a lot over the past few weeks and months here, and it's a company that makes up right around 15% of my stock portfolio. Well, in this video, I thought I'd come out and talk about three main things that Kevin talked about in his video. Also reacting to his price projections and revenue projections and how that differs from my projections for the company over the next 5 years here. So, hope you guys enjoy. So, the first thing that Kevin talked about is the rise and the fall of frozen foods. In his mind, there is a lot of individuals who actually spent a significant amount of time stocking up on foods over the past year here. Essentially eating a lot of frozen foods and stocking up on frozen foods, which essentially led to an uptick in demand for the Tattooed Chef. Now, I think Kevin is actually very wrong for this for a few main reasons. One, I think a lot of people, aside from around March, April, May, didn't really stock up on foods and instead actually spent more time to cook foods. Spent that hour and a half or 2 hours to make that nice home-cooked meal because everyone's got more time stuck inside. I think as the economy recovers and as more people get back to work, we're going to have less time on our hands. And what's one of those kind of solutions for that? A quick, healthy meal. What is that? The Tattooed Chef. Healthy meals that you can make anywhere from 5 to 10 minutes. So, what is one of the kind of main examples of this? College students coming back to school. College students have been off campus for a significant amount of time, at least a majority have. And I think as college students come back to campus, in around September, kind of after the summer here, we're going to see an uptick in demand for the Tattooed Chef's products, as this is essentially the Tattooed Chef's target consumer. Millennials, the younger generation, the ones who want healthy foods that you can make very quickly. What is that? That is the Tattooed Chef, and I think that will actually lead to an uptick in demand. So the next thing that Kevin talked about is SPAC Hype. Now, in his mind, due to the SPAC and just the general kind of feeling of SPACs around the investing community, there was a lot of people that came out to all the Costco's and all the Walmarts and all the Targets and just bought a ton of Tattooed Chef's products just because of the publicity the stock got. Now, in my opinion, this isn't something so huge that it will lead to a decline in revenue growth for the Tattooed Chef over the next years here. In my opinion, the amount of people that actually did this isn't that many. And the ones that did are the true investors, the true believers in the company, and the ones that will actually continue to consume and buy Tattooed Chef's products over the next few years here. So that's kind of my opinion on that. And you also have to kind of consider the fact that the Tattooed Chef has been growing revenues essentially exponentially over the past few years here. The brand was formed back in 2017. They did around $32.5 million in revenue. In 2019, that went up to $85 million. In 2020, that went up to $150 million in revenue. So that's also something to consider. Even before all of this, alleged SPAC hype, the company has been growing on a massive clip. So the fact that this may actually, lead to a decline in revenue over the next year here is a very overblown concern and something I don't really agree with. So the next thing is marketing spend. This is something that Kevin emphasized throughout the entire video, and it's something that I partially agree with. He believes that marketing spend will significantly impact the Tattooed Chef's ability to be significantly profitable. Now, what I agree with is that it will hurt profitability in the short term. Now, what is the goal of this marketing? The goal is to get the Tattooed Chef's name out, get brand awareness up, and to get more people and more loyal customers onto the Tattooed Chef brand. Now, in my opinion, a lot of the marketing spend that we'll see over the next couple years will actually, come to light and actually be recognized over the long run, over the next 4, 5, 6, over the next decade, in my opinion. If the marketing dollars don't actually, do too much or don't have an impact, I have a big belief that they'll just stop doing the marketing. I don't see a reason for them to pointlessly, throw money around into advertising if it doesn't have a significant impact on the business and their revenues. So in my opinion, if it does benefit revenues, then there's no reason they shouldn't be marketing. But if it doesn't impact revenues, I have strong belief that Sam Galletti, Sarah Galletti, and the team behind the Tattooed Chef will recognize that and just go back to naturally and organically gaining an audience just through, product look and product taste. Now, that's kind of my opinion on that. Again, a company that is a great example of this is Coca-Cola. Now, Coca-Cola, this is a brand that all of us know. We've all had at least one Coca-Cola in our lifetimes. Some even more. And you could consider that Coca-Cola a great example of a company that uses, advertising on a high level to benefit their business. I see Coca-Cola ads everywhere, whether it's on YouTube or on a TV or on a plaque somewhere in a giant store. Coca-Cola ads are everywhere. This increases brand awareness and is one of the reasons as to why Coca-Cola has been such a successful company, such a profitable company, might I add as well. They've managed to find that perfect balance between the amount of dollars they spend on marketing and the amount that actually impacts their revenue. So I think the Tattooed Chef will see essentially how much this will impact their sales, but if it does impact sales in a very positive way, I think this is an actual benefit to the company and it's just short-term noise. Yeah, so again, kind of like my main takeaway when it comes to these things, I think it's a lot of short-term thinking. I think it's a lot of things that, they won't be profitable this year, or maybe their revenue growth for this year may not be as good as it was in prior years because we're coming out of a pandemic. I think it's just a lot of short-term thinking. I'm a very long-term investor. I like to look out 3-5 years when I make an investment. You can even look out a decade for certain investments. But generally, I like to look out for the long term. And I think a lot of these concerns that he mentioned were very short-term concerns that won't really impact the Tattoo Chef's business over the long run. Now we're going to look at his projections when it comes to numbers. But before we do that, we need to take a look at the Tattooed Chef's original projections to get a better idea of how bullish or bearish Meet Kevin is being with these projections. So the Tattooed Chef says they're going to do around $222 million in 2021. They reiterated this in their latest kind of Q4 conference call, and I think it's very likely that they'll actually beat that. I'll explain in a second. Gross margin, they're expecting that to be around 20 to 25%, and adjusted EBITDA to be around $8 to $10 million. I'll just shrink myself for a second here. Now, they expect steady revenue growth over the next 4 or 5 years here. This is revenue growth of around 35 to 40%. They also expect gross margins to increase substantially as well, to over 35% over the next 5-6 years here. Keep that in mind. Gross margins of over 35% expected. And they expect adjusted EBITDA to get to over 20%. We'll see if that remains, or we'll see if that actually happens. Now, this may be my 5th time I'm recording this actual segment as it's very difficult to understand, so I'm really just going to try and summarize this as easy as possible when it comes to Kevin's projections. We look at Q4 earnings. These are kind of summarized. They had some kind of like accounting tricks that made their earnings look lopsided. I took that all away. We have revenue of $40 million, a gross profit margin of around 17%, operating expenses of around 11%, and then that gives us income of around 7% of total revenue, or $3 million, right? Gross profit minus operating expenses is equal to income. Keep that in mind. Then we've got his 2021 projections. This is essentially in line with the company, which expects to do around $222 million in revenue. Now, what is the red flag here? Gross profit is expected to be around 20% according to Kevin. The company is expecting to do around 20 to 25% in gross profit margin. Kevin's being conservative and choosing 20%. Now, Kevin calculated operating expenses of around 16%, and this is right, I agree with this. He took the company's expected EBITDA gain of $8 million for the year and essentially minus that by their gross profit, and you get the operating expenses. Gross profit minus income is equal to operating expenses, which increased substantially since Q4 of 2020. That is the red flag. Because of advertising, there will be a lot more expenses when it comes to operating the company, increasing from 11% of total revenue to 16% of total revenue. That is the one major red flag that Kevin saw. And this it's very interesting how we actually calculated these for the following years. And it's why I'm I'm disagreeing with him when it comes to these kind of growth estimates. He is expecting growth of 30% over the next 3 years here. I think that's very conservative. I think the company will grow substantially quicker than that. Anywhere from the 40 to 45% range is my guess. Now, with that, he has a gross profit of 20%. Why is this wrong? The company expects to hit a gross profit margin of 30 to 35% over the next 4 to 5 years here. And Kevin is using a gross profit margin of 20%. So because of this 20%, only 4% is going down to the bottom line. So for every $100 of revenue they're doing, only $4 is making it down to net income. Now, if this was 35%, we would have a substantially different valuation. And that's what we're going to look at in my model in just a second here. Given these 2024 numbers, this company is trading at a 75 price to earnings ratio. Given 2024 numbers, that is why Kevin sold out of the stock. So here we can look at just one extra thing that he mentioned during the video. This is actually off. He said that Beyond Meat is trading at a 5.6 price to sales ratio. Man, this thing's trading at a 15 price to sales ratio. So take that with a grain of salt. The Tattooed Chef is actually the cheaper company out of the two by a substantial margin. So now we can get into my numbers. And this is why I'm so bullish on this company, guys. Listen. So $222 million in revenue in 2021. What we really need to look at is gross margin, operating expenses, and net income margin. I'm using gross margin of 35%. This is essentially what the company is expecting to do by 2025. 35%. I do not think this should be at 20%. I do not think this should be at 20%. I think that is overly bearish in a massive, massive way. Then, operating expenses, and I factored in taxes, of 20%. That leaves us with a net income margin of 15%. And using that, we get net income of $151 million by 2025, right? And sure, I'm using a more substantial growth rate. I think they sandbagged their projections as they are a newly public company, so they want to keep expectations low just so that they can easily beat them in the future. So even if we use like a 40% growth ratio, we still get net income of $127 million by 2025. So, let's use a growth rate of only 40%. Using the current share price of $20 and the current market cap of around $1.7 billion, shares outstanding of 81 million, we get a price target of $62 5 years down the road, or essentially a 3x. And now, this is why Kevin is so wrong. His gross margins. We should not be looking at this company from a viewpoint of only a 20% gross margin. As they continue to expand, as they release new products, more profitable products, and as they move away from private label and move towards the brand, the Tattooed Chef, they will become more profitable over time, and I think they'll easily be able to hit that 35% gross margin as time goes on. Keep in mind, Sam Galletti, he is a veteran in the food industry. He's been in there for the past 20 plus years. He understands margins, he understands numbers. There's no way he would let this pass, knowing that they wouldn't be able to hit it. So in my opinion, this is where I'm sitting at with the Tattooed Chef. I'm going to leave this spreadsheet in kind of like not the comment section, but in the description down below, so you can kind of get a better sense of this. You can download it, you can play around with these numbers and see why I'm actually, much more bullish than Kevin is on the Tattooed Chef, and why so as well. So I hope you guys enjoyed this video. If you got any value out of it, make sure to share it with someone or hit that like button and drop a comment if you own the Tattooed Chef stock or are interested in owning it. It's a company I really like. So anyways, guys, thanks so much for watching and have a great day.